Hello, this is Cryptolyze. I hope you are well on this Sunday near October 2023. We meet today to talk about BTC, to talk about mining, because there are a lot of things. There is the halving coming closer. We are below 200 days before the halving. We must be at 198 days. We got news of a new miner that has appeared. We need to understand the impact of mining on the price of BTC. That's going to be the question and topic of today's video. How does mining impact the price of BTC? Can we use this to determine the price of BTC? I will give you my answer. Yes, we can, and I will give you my expectations. What will happen next? And it starts right away. Before starting the video, I remind you that we have a very important live show at 18. It's been over a year since I last did one. I'm doing a special live simply to meet you this October or near. It's going to be very important. We're going to talk about a lot of things. I can't wait to see you again, 18. See you later. When we talk about BTC, we must take into consideration that we must also talk about the industry behind it. It's a very important mining industry. It's a very big industry with behind the factories, entire hangars full of miners to be able to validate the blocks. This is the principle of proof of work. And miners are rewarded through transactions, transaction fees, but above all, the issuance of new tokens, new BTC, new Bitcoin. This show will change with the halving. Clearly, we are going to divide by 2 in 198 days the rewards that these miners will receive. If you've been following the channel for a while, you know a little bit about the explanation I have behind it. You have to understand that it's an industry. These are companies whose turnover is divided by 2, because overall, that's the principle. We divide the number of rewards by 2. They will go from 625 to 3125 BTC per block. Per block mined, not implied per block every time. And so that means that we really have all turnover, and that has a really strong impact. Historically, we have always had, before the halving, a launch of a new miner which impacts the sector, which will simply reduce energy consumption to be able to mine new BTC. And we see that we have had a new miner, but this time with much lower performance than historically. And we will understand the impact that this will have on the price, because we must understand that when a new miner appears, there is new financing to be had. We must also understand the structural part of BTC. There is not only the speculative part, there is not only the utility part, has the structural part, which is the companies which are behind, and how we actually manage this type of business and the impacts it will have in relation to that. We are moving forward with this new miner which has been released, which is here. So there we have the classic SP, the S19, which is present. So it is the one that everyone has, almost everyone. There are S17 and S19, and we have the S21, which was released with performances which are approximately 20%, 22, 23% above what we knew with the S19. Historically, when we looked at the difference between SS17 and S19, we really had gaps that were much larger. This is not the case, and that's why we're going to talk about it, because it has a very strong impact, very strong because we have drastic changes. What is good is that with Bitmain, we can directly look at the actual costs and especially the profitability of each of the miners present. We must understand that the S19, for example, in its current state, allows us to have a daily profit of $15. Meaning that we have energy for 4 cents, okay? So energy at 4 cents, that's not all they have. And we're going to tackle that a little later. You'll see, you'll quickly understand. So we still have a drastic evolution with the S21 Hydro version. Therefore, a particular version which allows us to have a much higher production cycle and, above all, a maintenance in any condition. Namely that in the Hydro, we do not necessarily have all which are in Hydro. We have a part which are in Classic S21, therefore which is still much less. We see already the gap between the two, and there it will be really impactful because we were waiting, many miners were waiting for this part to reinvest for the arrival of the halving. Obviously, if we have something that performs 60 minus 70% better than the rest, well, at that point, we say to ourselves that in fact we are going to move on. We are going to make the necessary investment to be able to buy back, because that implies that we have to sell the current fleet, because if we have S17 and S19, we have to have them. Sell, they have to be replaced with S21, and that requires financing. Concretely, how does it look on BTC? On this, I drew 2 indicators. Finally, 3 indicators which are the same but which are ruled differently. Here in the lower part, so this line there, we have the S21 Hydro. Here we have the S19 Hydro, and here we have the S17 to clearly show you the gap that we have between the two, and we can see very clearly the structural gap between the S19 and the S21 Hydro and the S19 and the S17 to clearly see the gap between the two and the impact it has on the market behind it. So with that, I'm going to show you the characterizations anyway. So it's something that's quite simple, in which I defined at 6.25, so which is the state current generation of BTC with 4 cents per kilowatt hour behind. On this, I remind you that there is not a majority who are at 4 centimes. It's between 3 and 4 centimes. These are the best deals we can have. And generally, we are at above. On the other hand, this indicator does not take into account several things. One, the investment cost, the capital cost, because when we buy behind, at a given moment, we have a loan, we have behind percentages that fit into it. We have a structural capital in relation to the infrastructures that we have, that is to say the maintenance of everything around, the employees, all of that we do not take into account. We also don't take anything else into account. It's an uptime. We have BTC miners to have deals like that. Don't mine at 100%, okay? They are not continually mining. This is the principle, is that they must mine on surplus, and therefore to have advantageous rates, they will not mine at 100% of the time. And that's why it doesn't fit in, and what's annoying, and that's why we're going to modify it a little bit. So 4 centimes, the best way to have an impact for me is to increase a minimum of 1 or even 2, depending on the situations we are in. So on that, it starts to give us a little more actually the cost of a BTC, because that's exactly what it is. We put everything back at 6, and we see that already those who are in SS17 are not profitable. We see that those who are in S19 are indeed profitable and are positioned here in the $15,000, which is approximately the production price that we find. And moreover, that's why I'm telling you that we're not very far from this idea, because we had an analysis from JP Morgan which explained that at the price per kilowatt hour, it was $3,800 when we counted everything, including investment, capital, management, maintenance, and renewal of the park. It was about $3,800 per kilowatt hour compared to strong structural electricity deals. So that represented roughly $15,000. And we see that we are not too far in our idea, in our representation on S19. And so I think we are really not far from this representation, and know that the difficulty will be made by the hash rate. So the more people there are on the network, the more complicated it is to mine, the less, in fact, it is profitable overall. So we already have a whole part of the S17 which are no longer profitable that we know, or in any case, which are either disconnected or which are maintained with very, very particular deals or an end of series, all simply because we still keep them to mine BTC to be able to sell them later. So this is what we call mining at a loss in the short term, and then in the long term with long-term valuation. But generally it is rather weak. But we have a ribbon which gives us general support. That means that from here to here, we are in fact in a period of profitability. It is the production costs of BTC. And it's important to see, because for me, it's the main support. You have to understand that this will be divided by 2 from the moment we arrive in the halving. This means that these production costs, already the 17 will pass directly, not necessarily very, very expensive. Finally, there you go. 27,000 x 2. So we will arrive at 54,000. We will arrive here from 15,000 to 30,000. And we will arrive at the last arrivals from 10,000 to 20,000, 21,000 exactly, because we have 10,500. On this, it is the classic element that we could say to ourselves, okay, well, at this moment, we will say to ourselves that there is perhaps the difficulty which will decrease, because quite simply, people will unplug. And therefore, at this moment, we are going to have a low phase. And I asked myself the question, what is the real impact of that and the halving? In relation to the hash rate, therefore, to the difficulty of the network, and structurally to the price. The price, the hash rate, therefore, the difficulty of mining, and the impact of mining, the reaction of both. And for that, I offer you this graph, in which I added a line, which is the line here in yellow, which is the representation of an SS17, because at the time of 2020, it was mainly S17. There was a little bit of S19, but it was mainly S17, which was during the bear market. And with behind the establishment of 12.5, which is the show before the previous halving. So we really have these characteristics, and we find ourselves in something where we see that we were already well below, and we did not have a hash rate that decreased. We even see that the halving, the hash rate, has accelerated. And it's important for me, I consider that, in fact, we have a turnaround which is taking place where people are reinvesting massively, and that downward pressure is taking place. Now, because people are simply liquidating and selling part of their BTC to be able to simply buy new miners, whether S17, which are being replaced by S19, and S19, which are being replaced by S21s, namely that the more an ASIC runs, the less efficient it is. So that means that an S17, which is already 5 years old, it will mine much less. It will be a lot less efficient. We consider that. It's about 10% per year of loss, and that's valid for graphics cards. It's valid for many things. So we actually have this depreciation which is taking place, and obviously the S19s now are less efficient than the S19s which were originally purchased, which is entirely logical. So we are in this perspective where we see very clearly that the hash rate has continued to rise. The only fall we have had here is the China ban, and that is normal being, given that we had a movement of miners who were in China towards other countries, or even a closure in a certain number. And we see that we have caught up, that we have even accelerated this momentum. And what is interesting to see is that we are going to come back here, and this time we are going to move all of the two lines again. And you will quickly understand what the point is. We're going to set it to 325, which is the representation of the new hash rate that we will have. And you will quickly see the impact that it will have on the BTC level. And there we can already define ourselves in relation to what we have known historically, that these are going to be the new prices, and that is the production prices. We must understand that a society does not operate just to produce for free. Production price is zero. This implies that I'm not losing money, but I'm not making any. The goal of these companies is to make money. And when we have a rule which is quite basic, it is generally the X2 production prices to have a strong structural margin in an industry like an overinvestment industry like BTC mining. It is roughly an X2 margin or even X3. And so there, we can already project ourselves quite quickly in relation to the halving, the effective impact in terms of the crushing of the margins, because we can see it here. It is the gap between the two. We see that at the halving level, we were here in the yellow curve. We passed into this green curve here. You can see the difference. All that is the margin that was lost by the companies. So this implies that we are not in the right graph here, a difference which will occur with an overall multiplication by 2 of the price difference. And so this implies that the S19, which will always remain in production, will have an effective price in the region of 28,000, 29,000. And here in this 21, we will be in the region of 20,000 up to potentially 21,000. All right, so we will be in these gaps there. So we can very well go and retest these areas, but that implies that we are just afloat. And so given that we are going to have a Shrek that will continue to increase, that implies that we will continue to have an increase in difficulty. It is very likely when we continue like this to have a hash rate when we look at the evolution that we have, which will take place in this way. And therefore, in terms of evolution, we see very quickly that the price of profitability with the new halving, with the new issuance of BTC, will be around 33,000 for the S19, and therefore from 25,000 to 33,000, which is the range that I have defined for some time, 25 minus 35, in which we risk oscillating before having the break, the retest, and the upward acceleration, which will here be the recovery of the margin of the industry, which is behind. Understand that these are companies. Their goal is to make investments. These are not people who are there mainly. Go for the decentralization of BTC, strengthen the idea, the ideology behind it. We are really very, very far away. We are among people who will seek the return on investment and the return in terms of daily profit. They will calculate what is the annual ROI of the investment they are going to make, knowing that it is an industry which must continually renew its fleet. So there are continuous investments which are made, a S21 HT today in 5 years, with the hash rate, with behind the increase in difficulty, with the wear and tear of the equipment. These are investments which will be remade. And the other thing that there is to take into consideration, and which is still different, and which we do not take into consideration enough, is that here, in that period, in fact, there was a rupture real at the level of everything that was ASIC, all right? It was very complicated to get it, and we had to pay very, very expensively, and with delays that were really very, very long, and that's something that's no longer the case. Clearly, I think Antminer and Bitmain are going to be ready. In fact, Antminer will be ready to be able to produce and have access, so we risk even potentially having an acceleration of the hash rate, which will be effective, and therefore an acceleration of the price, because if we have a production price which increases, that implies at a given moment that the margins are shrinking. We can very well have margins which are shrinking, but at a given moment, there will be a real valuation of the price, which will be done in relation to the interest of the investment, and the business which is around. There are two possibilities here. Either we arrive at a real valuation of BTC, or we arrive at a reduction in the interest which is focused on the mining industry, and therefore behind people who will unplug machines. But to have that, it will be replaced by new players who will reinvest. For the moment, we will have more of a stabilization of the hash rate rather than a drop in the hash rate. And so there we will perhaps have the establishment of a price which will be representative of the real price of BTC by removing the notion of speculation. Except that we do not take into consideration the arrival of ETFs, the arrival of liquidity, the arrival of the also very speculative aspect which comes into play because it is a bit of a self-fulfilling moment in which people reinvest, are preparing for the halving, and it is precisely not the time for the halving, but it is a few months later where we see the accelerations. When we look in this area, we see very clearly that there we have the halving, the acceleration occurs subsequently, 1 month, 2 months. 3 months later, same here, we then have the reacceleration and the bull run which takes place. But we have a valuation which arrives in the months which follow the halving. It is not a magical day, but in all. This is a difficult day for a miner. Understand that because he simply sees his salary halved. I hope you liked this video. If so, don't forget to leave me a like and a comment. It always makes me very happy. And we'll meet up for the live at 18. I'll see you right away.